This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. That assumption is that when you put money in bonds, and I'll use this as an example, if we call this, I'm going to cheat for a second, if we call this our bond part of our portfolio, and to illustrate it, we'll make it colorful. And let's just say that's, 30%. And then the stocks and the other things are in there. In the past, if you're in a cycle where stocks aren't doing well, bonds will typically go up. But if you look at this graph up here, this is the last 50 years of interest rates. And we have now approached the point, the little line is the Fed funds rate, and it's pretty much at zero. And the blue line is the Treasury rate, and it's as low as it can go. And so if you put money in bonds, because when stocks don't do well, the juice you get from bonds is actually questionable, because if interest rates go up, what happens to bonds? They lose money. So we think interest rates are going to go up. We think interest rates are going to go up for all sorts of reasons, but one of the reasons is, China, for example, they downgraded the credit of the U.S. government when we announced we're going to print another $800 billion. Well, what does that mean? It means that the international community is not willing to loan our government any more money unless we pay them some more interest. Core interest rates have to rise, and they have. In the last quarter, core rates on 10-year notes went up over 1%. So if this is the beginning of a longer-term trend, asset allocation, the efficient frontier modern portfolio theory, doesn't really work so well. Look at this chart up here. So in a interest rate environment from 1955 to 1980, stocks made 10%, but inflation was around 5, so they netted 5 in front of inflation. And rising still made 4% because, again, you're kind of getting an average of all of those years. But after inflation was a negative result, and then, of course, what we've been used to for the last 30 years has been interest rates going down. That helps stocks. Interest rates go down, stocks are in a better position, and the bonds have made 9%. So this whole asset allocation thing is probably finished. I mean, it probably isn't going to work anywhere near like it should in a rising interest rate environment. So we would actually see rising interest rates are not going to support prices of stocks expanding as easily. We think rising interest rates are not going to help any kind of bond appreciation in cash. If the Fed manipulates the yield curve to zero, cash is going to earn zero.
The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest directly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation, and/or fees and expenses associated with investing.